Everyone loves hearing about people making huge money from dividends, 5 grand, 10 grand a month. But have you ever wondered what happens when you start small? What does that first step really look like? Can you actually build something significant with just 10 grand? That's exactly what Josh was asking himself. So he decided to test it out for himself. He wanted to know, could he make a real steady income from just $10,000? Could it grow into something worth his time? Or would it feel like a slow, unpredictable ride? In this video, we'll walk through how Josh built his $10,000 dividend portfolio, how he chose the right stocks, how the income flows in month after month, and what it looks like when the dividends actually start coming in. And by the end, I'll show you how those early small payments, if reinvested, could grow into a $480,000 portfolio that pays more than 22 grand per year in dividends. But before we get to those numbers, it's important to understand the approach Josh took to make all this work. Before Josh bought a single stock, he changed the way he looked at his money. He stopped asking, how much can this grow? And started asking, what job can this do? It might seem like a small change, but it made all the difference. Rather than chasing market fluctuations or checking prices every day, Josh focused on income, dividend income that is. A dividend is simply a company sharing part of its profits with you for holding its stock. When the company does well, you get paid. It's not about selling shares, it's about getting paid to own them. Josh also decided he wouldn't spend the dividends he received. Instead, he set up automatic reinvestment, or DRIP. This means every time a dividend is paid, it automatically buys more shares, and those new shares start generating their own dividends. At first, the amounts will be small, just a few dollars here, a few dollars there. But Josh knew this wasn't about the size of the payments at the start. It was about building momentum. Once the dividends start working for themselves, time becomes the real power in the strategy. With that mindset, choosing the right companies became a lot easier. When Josh started choosing companies, he kept it simple. With only 10 grand to work with, he knew every position had to pull its weight. So he set up a straightforward filter and stuck with it. The first thing he looked for was stability. Josh wanted businesses that could make money in any market, not just when things were going well. Companies that sell essential products or services are more likely to hold steady when the economy slows down, something that's crucial when you're relying on consistent income. Next, Josh paid attention to the company's dividend history. It wasn't enough for a company to pay a dividend right now. He looked for businesses that had a track record of paying and increasing dividends over time. A long history of consistent payouts is a sign of financial strength and commitment to shareholders. He also checked the payout ratio. This number shows how much of a company's profits are being paid out as dividends. If it's too high, the dividend could be at risk. By focusing on healthy payout levels, usually below 60%, Josh reduced the chances of unpleasant surprises later. Diversification is another priority. You don't want all your income coming from one sector. Spreading investments across different industries helps smooth things out if one area struggles. Finally, there is the balance. Some companies would provide solid income today, while others might grow their dividends faster over time. Together, that mix created a portfolio designed to be steady now and stronger later. Once Josh knew what he was looking for, building the portfolio became all about keeping it simple. With only 10 grand to work with, he didn't want anything too complicated. So he divided the money evenly across 10 positions, investing $1,000 into each one. This way, no single stock could overpower the results, either positively or negatively. Each position had an equal role to play, making the whole thing balanced from the start. He then organized the portfolio into 4 clear categories. The first category is a dividend ETF. This acts as the anchor of the portfolio. Instead of relying on just one company, the ETF spreads money across dozens of strong dividend payers. This adds built-in diversification and helps keep the overall income steady, even when individual stocks move around. Next, Josh adds established blue-chip dividend stocks. These companies have a long track record of strong earnings and consistent dividend payouts. They make up the core of the portfolio, providing reliable income Josh can count on year after year. The third category is real estate income through REITs, real estate investment trusts. REITs are required to pay out most of their profits to shareholders, often providing higher yields. Adding this layer increases income and helps smooth the overall cash flow between quarterly payments. The final piece is growth-oriented dividend stocks. These companies may not have the highest yields now, but they have the potential to grow their payouts over time. This growth adds long-term strength to the portfolio. By spreading his investment across these 4 categories, Josh creates a balance between getting income now and positioning himself for stronger returns later. It's a simple structure, but it's intentionally designed to work together, steady now and stronger in the future. Even with this solid structure in place, Josh knows that some mistakes could still weaken his results if he's not careful. One of the biggest traps is chasing high yields. When a stock offers a huge dividend, it can be tempting, but often, a very high yield is a red flag. It could mean the company is struggling or paying out more than it can afford. Josh avoids anything that seems too good to be true. He also keeps a close eye on payout ratios. If a company is paying out most of its profits as dividends, there's not much room for error. A rough year could force the company to cut its dividend. By sticking to healthier payout ratios, Josh lowers the chances of that happening and ensures his income stays steady. Another mistake to watch out for is expecting a perfectly even monthly income. Most companies pay dividends quarterly, not monthly. Without understanding the schedule, the income can feel all over the place. Josh built his portfolio knowing some months would be stronger than others, and that's perfectly normal. He also avoids putting too much money into one sector. If all his dividends are coming from the same industry, a downturn in that sector could impact his entire income stream. So he spreads his investments across different areas to reduce risk. Next, I'll show you how Josh selected his stocks and what kind of dividends they pay starting in year 1. And by the end, I'll show you how this same portfolio, if reinvested, could grow into a $480,000 portfolio that pays more than $22,000 per year in dividends. But first, let's take a look at the stocks Josh picked for his portfolio. With the risk minimized and the structure set, here's a look at the exact companies Josh picked for his $10,000 dividend portfolio and how each one fits into the plan. The foundation of the portfolio starts with the Schwab US Dividend Equity ETF, SCHD, which yields about 3.34%. Instead of relying on a single company, this ETF invests in a collection of strong dividend payers. It's the anchor of the portfolio, offering built-in diversification and stability while still providing steady quarterly income. Next, Josh adds a group of blue-chip dividend stocks. NextEra Energy, with a yield of 2.53%, brings exposure to the utility sector, especially in renewable energy and regulated power demand. Procter & Gamble, yielding 2.69%, offers reliable income from consumer staples, products that people buy no matter the economic climate. PepsiCo at 3.42% adds strength through its global brand and steady cash flow from snacks and beverages. Black Hills Corp, yielding 3.93%, contributes a higher utility yield, strengthening income and stability. AbbVie, at 3.1%, adds healthcare exposure, with a track record of strong dividend payments backed by pharmaceutical revenues. Then Josh includes a real estate layer with Realty Income, yielding about 5.14%. What sets this one apart is that it pays monthly dividends, which helps smooth out the income flow throughout the year and boost the overall yield of the portfolio. Finally, there are the growth-oriented dividend stocks. Nexstar Media Group, yielding around 3.1%, brings in media exposure with solid income potential driven by advertising revenue. Goldman Sachs, at 1.91%, adds diversification to the financial sector and exposure to the investment banking strength. Lowe's, yielding 1.73%, is a long-term dividend grower tied to the ongoing demand in home improvement and housing trends. These 10 positions give Josh exposure to different industries, balancing stability, income, and growth in one system that's designed to work over time. This setup adapts as market conditions change, ensuring the portfolio can take advantage of new opportunities and shifts in the economy for years to come. So now the big question is, what do these companies actually pay him each month? Each stock in Josh's portfolio has $1,000 invested, and while dividend income doesn't always come in perfectly equal amounts each month, Josh knew that going in. The best way to see the pattern is to group the payments by when they're scheduled to arrive. In January, April, July, and October, Realty Income pays its $4 monthly dividend. On top of that, Procter & Gamble adds about $7, AbbVie contributes around $8, and Lowe's brings in about $4. Together, these months total about $23, creating a steady base that feels consistent and predictable. In February, May, August, and November, Realty Income again pays its $4. Next Era Energy adds around $6. Black Hills contributes about $10, and Goldman Sachs provides roughly $5. These months total about $25, making them a little stronger and more noticeable in the account balance. In March, June, September, and December, Realty Income still pays its usual $4, but now it's joined by SCHD with about $8, PepsiCo contributing around $9, and Nexstar Media Group adding about $8. These months total around $29, making them the highest paying months of the year. When Josh looks at everything combined, the portfolio produces around $309 in annual dividend income. Dividing that over 12 months, it averages about $26 per month. Some months land closer to $23 and others rise closer to $29, but the overall flow stays steady and reliable. For Josh, this portfolio doesn't replace his paycheck, but it does provide some extra reliable income. It could cover a small utility bill, a phone plan, part of groceries, or just be reinvested without him feeling it. At first, $309 a year, about $26 per month, might not seem like much for a $10,000 investment. It's not going to change his life overnight. But Josh isn't looking for instant results. He's focused on long-term growth. It's real money showing up on a schedule, and that consistency is where the next stage begins. When Josh reinvests in this portfolio over the long run, here's what the projections show. In the first year, most people might overlook $300 in annual income. It's not life-changing. But Josh knows that this is just the starting point. As he reinvests every dividend, the growth will begin to stack up. By year 10, the projected annual dividend income will grow to around $1,000. That's more than triple the starting amount without adding extra money. The payments will still be manageable, but they'll clearly show momentum building. By year 20, the change becomes more noticeable. The projected annual dividend income will climb to about $5,000. At this point, the income will no longer be just a small boost. It could cover more meaningful expenses, like part of the rent, a car payment, or utilities. By year 30, the effect will be dramatic. The portfolio will be generating about $22,000 per year in dividends, or about $1,833 per month. What started as $300 in year 1 will have grown more than 70 times simply through reinvestment and time. At the same time, the portfolio value grows alongside the income. By year 1, the account will be around $11,000. By year 10, it will grow to approximately $34,000. By year 20, it will approach $125,000. And by year 30, the portfolio value will climb to nearly $486,000. Most of that growth doesn't happen early on. It builds up over time, once the snowball is rolling and momentum takes control. Want to know how to turn the same $25 a week into a $1.6 million portfolio that pays over $6,000 in dividends every month? Click the video on screen to find out how.